you might have observed the increasing prices in the real estate market. This development was anticipated because inflation rates are also on the rise as time progresses. In response, the Federal Reserve is increasing interest rates to counteract inflation. This is resulting in higher costs associated with borrowing money, including mortgage loans. The expectation is that elevated interest rates will have a dampening effect on both home sales and the growth of property prices. Welcome to Nova Society, your ultimate destination for mastering personal finance. Don't miss out on being part of our community. Renowned billionaire investor Warren Buffett is sounding the alarm about an impending crisis poised to hit the U.S. real estate market. A colossal $1.4 trillion debt-driven wave has already begun to make its presence felt in the real estate sector as we speak. Nevertheless, this marks just the initial phase of the repercussions that Buffett anticipates from this real estate bubble. The true magnitude of its impact is expected to become evident in a matter of months.
But it all has consequences, and I think we are starting to see.
Over the past 15 years, the U.S. real estate market has been driven by substantial amounts of affordable debt. If you look at this chart representing the U.S. federal funds effective rate, which serves as an indicator for interest rates in the economy, you'll notice that interest rates have remained close to zero for the majority of the last 15 years. These persistently low interest rates have encouraged the utilization of significant debt and have propelled real estate values to soaring heights. To illustrate, consider someone buying an office building in your hometown for a neat $1 million. This buyer likely needs an extra $1 million in cash sitting idly in their bank account to purchase the building outright. Instead, they'll probably approach a bank to secure a loan, covering most of the purchase price. In this scenario, the buyer contributes $350,000 in the form of equity, essentially a down payment. Following that, the buyer obtains a loan for the remaining $650,000, likely from a local bank. The profitability of this purchase hinges on various factors, with one of the most crucial being the interest rate on the loan. Suppose our buyer secures an interest-only loan at a 5% rate. This means the buyer is obligated to pay 5% of the total loan amount in interest payments to the bank annually. This interest payment is equivalent to a mortgage payment for a homeowner. At a 5% interest rate, the annual debt payment to the bank amounts to $32,500. The property's ability to support this debt payment depends on its net operating income, which is the income generated by the property minus expenses related to its ownership and management. In this example, let's assume the office building generates an annual income of $60,000 for its owner. As we can see, the property generates enough income to cover the debt payment comfortably. One crucial metric that banks consider when evaluating whether to provide a loan for a property is the debt service coverage ratio, DSCR. This ratio measures the property's breathing room to meet its debt payment in case circumstances take a negative turn. Banks typically prefer a DSCR greater than 1.2 times. In this case, with a 5% interest rate and a net operating income of $60,000, the property meets this criterion easily, with a DSCR of 1.85 times. This low interest rate made the purchase of the property highly profitable for our buyer, despite the majority of the purchase being funded with debt from a bank. However, let's explore what happens when interest rates increase in the U.S. While most home buyers typically secure a 30-year fixed-rate mortgage, where the interest rate remains constant for the entire loan term, commercial property buyers are not as fortunate. Commercial loan interest rates reset every 3 to 5 years to the prevailing rate for that type of loan. This distinction can have a significant impact on commercial property owners. Returning to our example of the $1 million office building, if we raise the interest rate from 5% to 7%, the annual debt payment jumps from $32,500 to $45,500. The financial situation of the property becomes more challenging due to the significantly higher debt payment. However, assuming the property's income remains unchanged, it can still cover the debt payment. Now, let's take it a step further and increase the interest rate to 9%. The debt payment for this building surges to $58,500. At this point, the $60,000 income generated by the property barely covers the debt payment. However, it's important to note that this is an office building, and the rise of remote work has significantly reduced the demand for office space, likely permanently. Let's imagine the property's income drops from $60,000 to $40,000 due to tenants not renewing leases and increased vacancy. Under these circumstances, the property owner is in serious trouble. The property's income is no longer sufficient to cover the debt payment, and as a result, it's likely heading toward foreclosure. The bank will seize possession of the building and sell it to a new owner, probably for a fraction of what the initial buyer paid. Ultimately, the bank will absorb the loss on this loan. Here's Buffett explaining how the real estate market found itself in this predicament in the first place.
Most people like to buy with non-recourse in real estate, and one time I asked Charlie, there was some real estate guy we were talking to him, and how do they decide how much a building like this is worth? And the answer is it's whatever they can borrow without signing their name. And if you look at real estate generally, you'll understand what the phenomena that's happening if you remind yourself that that's the attitude of most people that have become big in the real estate business.
When you borrow money to purchase a home for personal use, you typically have to sign what's called a personal guarantee. In simpler terms, this means you are personally responsible for repaying the bank regardless of what happens to the house's value. For instance, if you have a $400,000 mortgage, and the house's value drops to $300,000, you are accountable for covering the difference. You can't simply return the keys to the bank and walk away because a personal guarantee is associated with the mortgage. The bank will compel you to make up the shortfall, or you may need to file for bankruptcy. However, in the realm of commercial real estate, the situation works differently. Typically, large commercial properties such as office buildings, apartment complexes, and warehouses are acquired using what's known as non-recourse debt. Here's how it functions. Suppose a significant real estate investment firm buys a property for $50 million. The firm contributes $10 million and borrows the remaining $40 million from a bank in the form of non-recourse debt. After a few years, when it's time for the interest rate to reset, which is common for commercial real estate loans, the property's value has fallen to $30 million. In the case of non-recourse debt, the property owner can return the keys to the bank and walk away. The large real estate investment firm loses the $10 million they initially invested to purchase the property, but the bank is left with a property worth less than the loan amount. Since this loan is non-recourse, the bank has no option but to absorb the loss. This isn't just a hypothetical scenario. There's an estimated $1.4 trillion worth of such loans coming due in the next 12 to 24 months. Many of these properties are now worth far less than their purchase price or cannot sustain the higher debt payments due to rising interest rates. Consequently, a significant portion of these properties may end up in foreclosure. This trend is already starting to emerge, with one example being Starwood, one of the largest real estate investment firms globally, defaulting on a $212 million loan for an office building in Atlanta. The building's value had diminished significantly, and rather than negotiating with the lender to salvage it, Starwood essentially returned the keys to the bank and walked away. While this may be one of the initial stories, there will likely be many more to follow. The consequences of these defaults could have long-lasting effects, extending beyond the commercial real estate market. The American banking industry is primarily dominated by large banks, as evident from their combined assets of $14 trillion. However, it's surprising that small regional and community banks, not the big Wall Street banks, account for the majority of commercial real estate loans, estimated at around 2/3 of all such loans. Therefore, it's these small banks that will bear the brunt of the losses from commercial real estate lending, as opposed to the large Wall Street banks. This, in turn, may have subtle but significant repercussions. These small banks are also the primary lenders to small and medium-sized businesses that drive many local economies. While the big Wall Street banks cater to Fortune 500 companies, these smaller banks support the businesses that are essential to cities and towns. The losses incurred by these small banks from their commercial real estate loans might not force them to significantly curtail lending. However, it could hamper access to credit for small and medium-sized businesses, making it more challenging for them to expand, hire, and spend. Ultimately, this could negatively impact economic growth. In conclusion, while the outcome in the real estate market remains uncertain, one thing is clear, as highlighted by Charlie Munger, Warren Buffett's business partner: there will be pain, but the question is, who will bear the brunt of it? In general, the real estate market in 2023 is projected to exhibit a more subdued performance compared to recent years, with no imminent crash anticipated. Home prices are still predicted to see an increase, but at a reduced rate due to the influence of rising inflation on housing costs. The elevated costs of construction materials and labor are contributing to the upward trajectory of home prices. While home sales are expected to decrease, they are projected to stay above the levels seen before the pandemic. If you want to learn more about personal finance and generational wealth building strategies, visit our channel and subscribe for more enlightening videos to increase your wealth.